Greetings everyone, and welcome to this edition of JIC Research Edge. My name is Matt Young and I'm a Senior Portfolio Manager here at Johnson Investment Counsel. I'm joined by my colleague Kristen who is a research analyst covering mostly economics and fixed income for the team here at Johnson. So the past couple of years have been crazy, right? Due to COVID, right? We had some lockdowns and we're still dealing with some supply chain issues, and now sort of 2 months into the war in Ukraine. And all of us have sort of been watching the news, and we know that oil prices have been going up, which sort of parlay into gas prices for all of us at the pump. So why have gas prices been going so high, and where do you see them going from here?
That's a great question, Matt. And as you kind of mentioned, energy prices have really been affected by the conflict in Ukraine. Russia is the largest producer of natural gas and the third largest producer of oil, right behind the United States and Saudi Arabia. The US, along with some other developed nations such as the EU and the UK, have placed outright bans or sanctions on Russian imports, specifically on energy imports. So though we have seen gas prices rise in the US, it's actually been more fear-based. We saw gas prices increase pretty significantly in mid-March around the fear of not being able to get that energy supply. On the other hand, Europe is much more reliant on Russia for its energy exports, with 40% of the EU's natural gas supply coming from Russia and over 50% of Russia's exports of gas going to the EU. It's really difficult to say where we think gas prices are going to go from here. As I did mention, the US is a lot less reliant on Russia for energy sources compared to the EU. The administration has also implemented several cost-saving strategies to help bring gas prices down, such as releasing strategic oil reserves, as well as kind of loosening the standards on oil. The University of Michigan actually publishes a consumer sentiment survey that gauges how consumers are feeling about the economy, how they're feeling about expectations for the economy. And the March report indicated that consumers expected a 50-cent increase in gas prices 1 year from today. And the April report, released obviously a month later, indicated that consumers only expected a 0.4-cent increase in gas prices 1 year from today. So we went from a 50-cent increase to a 0.4-cent increase. And I think that's really saying that it was a lot more fear-based. The administration is doing a lot to help calm the nerves, and we are a lot less reliant on Russia for our energy sources. So consumers aren't expecting a big run-up in gas prices.
So as it parlays from gas prices to sort of the broader inflation impacts, could you elaborate and help us unpack for our audience the biggest drivers of inflation, and are we going to remain high from that standpoint going forward?
So basic economics tells us that price is really a function of supply and demand. And unfortunately, what we saw in 2021 and kind of through this first half of 2022 is a big increase in demand and a lack of supply. So we kind of have this double whammy when it comes to inflation. If you think about where we were in 2021, we had quarantine, we had work from home, people weren't getting out and spending money on service sectors such as restaurants, leisure, travel, entertainment, and instead what they were spending money on was goods. So they were spending money on exercise equipment and furniture, technology, and all of that was really exacerbated by federal stimulus. So the consumers got stimulus checks, they had extended unemployment benefits. All of this exacerbated that goods spending. And on the other hand, we really had a lack of supply. So not only did we have labor shortages in the United States, but we had labor shortages globally, and the US is a big importer of goods. All of this contributed to decades high inflation that we really haven't seen since 1980. Now moving forward into 2022, this has all been exacerbated by the Russia-Ukraine conflict. So now we're starting to see some deflationary impacts in the goods sectors. However, we're seeing inflation impacts from energy and food and other commodities. And I think it's pretty difficult to say how sustainable we think inflation is going to be. And that's really just because it's been caused by some of these unpredictable exogenous factors such as a pandemic and war. When we think about long-term sustained inflation, we think about demographics and high debt levels and productivity, and all of those things indicate that we should actually have lower inflation. Most economists expect that we actually hit the peak in CPI year over year in March as we start to roll off some of those really high 2021 CPI prints. We may actually start to see and have already started to see a dichotomy or a divergence between core CPI and headline CPI. Core CPI just excludes food and energy, and that's because of the volatility that is exhibited in those sectors. And those are the sectors that are going to be most influenced, most affected by the war in Ukraine. So we may start to see headline CPI continue to rise, whereas core, excluding those sectors, may start to come back down. However, ultimately, slowing economic fundamentals, an aggressive Fed tightening cycle, all of this should lead inflation back to that 2% average target.
2% sounds pretty good. I don't know about you folks out there, but that sounds delightful to me. So that's the Fed's target, right? And they've said that for a very long time. What is the Federal Reserve, aka the Fed here in the US, the central bank, doing about this inflation? And what is the market pricing in for them to do going forward?
Right, so the Fed has begun their tightening cycle. They raised rates by 25 basis points on March 16th. And since then, we've seen several Fed members, including the chair, Jerome Powell, come out and say they would be in favor of 50 basis point hikes at upcoming meetings. The market has since fully priced in 50 basis point hikes at both the May and June meetings, as well as higher probability of 50 basis point hikes at the July and September meetings. Furthermore, the Fed plans to reduce their balance sheet, which currently stands around $9 trillion. This helps to kind of drain liquidity from the financial system and almost acts as implied rate hikes without actually having to hike rates. The Fed has also indicated through their dot plots that they plan to invert the curve and hike above neutral, neutral being where the economy can still grow without financial conditions being too tight and too detrimental to growth, to unemployment, and such. If the Fed does hike above neutral, this will cause an inverted yield curve. An inverted yield curve typically is very detrimental to growth, will cause a weakening economy, and should cause inflation to come back down to normal levels. The market has been increasingly ahead of the Fed since late October of last year. They were pricing in 1 rate hike for 2022, and that now stands at 10 rate hikes for 2022. So this means that though we are going through an aggressive Fed tightening cycle, much of this has already been priced into bond yields, which is why we've exhibited negative returns for the fixed income asset class. However, the future for bonds is bright. As we know, higher bond yields just indicates higher expected returns.
Well, I'll get my sunglasses out for this bond market going forward. Thank you, Kristen, for coming on the program, and thank you all at home for tuning in today. As always, if you have any questions or want to dive into some of these topics further, feel free to reach out to your portfolio manager. Until next time, take care of yourselves and each other.